We are nowhere near a bear market, not even by a moonshot close. So I would say bonds are more likely to suffer than any other asset class out there. During a crisis, what do you do with your insurance policy? You cash it in.
S&P 500 up or down by the end of the year? I'm pleased to welcome to the show David Cervantes, founder of Pinebrook Capital Management. He has a great Substack that we should follow. Link down below in the description. Prior to Pinebrook, David was on Wall Street for many, many years, working in fixed income sales at Morgan Stanley and also in cross-asset sales at UBS and JP Morgan. Welcome to the show. David, good to see you.
Thanks for having me. Happy to be here.
This is starting to look like 2022. What I mean by that is we're having an environment where the equities are selling off in the beginning of the year, and it's been the worst since 2022. And we're also looking at possibly no more Fed cuts this year. If you look at the CME Fed Watch tool, the markets are not pricing in any significant cuts or any significant probability of any cut until late 2026 December, if not 2027. This is starting to look like 2022 all over again, when everything fell, including bonds, including stocks. Which do you think will survive this storm this year, David? Will it be stocks or will it be bonds? Do we still have room for the 60-40 portfolio is my first question.
The answer is we do have room for the 60-40 portfolio. I know that correlations are historically out of whack, but I think the broader question is, how is the cycle? Ultimately, equities and fixed income are derivatives of the business cycle. So I think it's more informative to look at the cycle and where it's going. Obviously, we came into the year pretty soft on the GDP front. We had a third revision yesterday on Q4, down to 0.5, down from 0.7, I believe, and the original 0.8. But that was just a function of the government shutdown in Q4, and we're getting a little pop, and actually some mid-quarter acceleration in the economy, and then the war happened. That kind of put the lid on that for a while. So my view is that we are going to have a growth hole in Q2. Q1 overall will be very soft, not recessionary. And again, this is somewhat of a function of the disruption in the Middle East and this disruption to what really matters, the flow of oil, not the paper futures, but the actual physical oil getting out and getting delivered. Hopefully those things are resolved at some point in the near future. And then Q3, we're looking at, kind of coming back on, getting supplies back online. That's a transitional phase with some acceleration in Q4. So just to sum it up, I think, equities will be all right. Fixed income, it's kind of a toss-up with fixed income because we've got two opposing forces. We've got inflation, and then we've got also just the labor market. So, it's going to be a toss-up on the fixed income side, I think.
With a 10-year yield rising to 4.3%, and it's been going up ever since the beginning of March. What do you think the bond market is signaling?
The bond market signaling that yields were a little lower than they popped up with this inflationary spoof, but right now there's not a whole lot of signal in there, and the reason is, for the most part, the labor market is balanced. We've had little employment growth, but due to the demographic changes resulting from President Trump's immigration policies, break-even levels to maintain a fixed level of employment have collapsed. So, we're kind of, that goes back to my thesis that we're kind of at a standstill with bonds. They're neither here nor there. The labor market is stable, so there's no impetus to cut. Inflation, it's a supply shock, and the Fed typically looks through supply shocks. So, there's really not a lot of signal from the fixed income market right now.
I'm looking at my screen here. This is a chart of the 10-year bond yield in the bar chart, and the blue line is the WTI oil price. Is it normal for oil and the long end of the bond yield curve to be perfectly correlated? As we can see, ever since March, they've been doing that. Yeah.
Yeah, historically they are because, typically, inflationary impulses start in the energy complex. There was a difference after COVID where the main source of inflation was the housing market, but that's historically, inflationary impulses start in the energy complex. So that's why they track so well together.
So basically yesterday, the 9th of April. The S&P closed extending a 7-day winning streak. It's longest since last October, David. So the index is still down about 4% year to date. Is this a bear market rally, or is the bottom in, you think?
Well, we're not even in a bear market, right? I mean, currently, the year-to-date return is 0.31%.
Yeah.
And at the bottom of the index last week, I think 6,300 handle, we were around 10%, give or take. So this is just volatility and correction. We are nowhere near a bear market, not even by a moonshot close. You could make that argument if we were pushing minus 18%, 20%, but at minus 10%, that's historically a run of the mill kind of correction that you have once a year, once every 18 months. That is nothing. There's nothing remarkable to that. Now, what is interesting though is the kind of a sideways pattern that we've seen since basically October 28th. October 28th is when 28th last year is when tech peaked, and then after that it was kind of sideways going into February, into the war. So the question is, are we, if we can get this or move past the geopolitical situation with a favorable outcome, or at least not a bad outcome, the question is, do we keep grinding sideways or do we eventually move up? I'm in the camp that we'll move up. And the reason is estimates are still being marked up. Now, typically estimates lag the market, right? The market front runs. But look, we are a hair away from all-time highs. Right now the market is telling us that these estimate increases are still to be considered valid, right? If the market were down 15% and analysts are still raising estimates, then someone's wrong. It's typically the analysts. But here we have kind of a cohesive alignment between what the market is doing and what the estimates are doing. So I don't see I think the resolution will be at some point a breakout to the upside.
This is an interesting piece that you wrote. This is called The Great Unrotation. And you pointed out that the real opportunity lies in not just oil itself, but the entire supply chain mechanism. So to understand how the current disruption propagates through the economy, we must map the industrial chain. The war-driven supply shock begins with energy and transportation disruption, but quickly spreads through the petrochemical and fertilizer systems. Geopolitical conflict causing energy supply disruptions, causes refining and petrochemical stress, sulfur and chemical feedstock shortages, fertilizer and industrial input shortages. And you said that this sequence describes the industrial aftershock mechanism. Importantly, each stage produces a different set of sector winners. Tell us more about this and which are ultimately the sector winners here.
Yeah, so the basic idea is the disruption is going to create choke points in the supply chains, right? And the choke points you want to be long some of the choke points, not all of them. You want to be long the choke points that have pricing power and can absorb the increased costs and pass them off to consumers. You don't want someone that has to absorb the costs and not have the opportunity to pass them off to consumers, because that kills their margin. So the idea is to focus on choke point positions that are placed to actually expand their margin as a result of this, right? So inputs increase, but can your output price increase at the same rate or more? So that's where you want to be long, right? You don't a company like Deere, they during this whole disruption, they got hit hard, right? Because their input costs went up asymmetrically relative to their ability to pass those prices off. So that didn't pan out well for them. Now, a Valero Energy, a refiner, as long as they can maintain their margins, they will benefit from these kind of choke points. So there is a distinction in between who you want to be long and who you want to avoid.
Before we continue with the video, let's talk about a company that's building serious gold leverage for the long term. Our sponsor today, Stellar Gold, is sitting on 3 major Canadian projects. Tower and Colomag are among the largest undeveloped gold sites in the country. The Tower project alone could be worth $2.5 billion after tax at a $3,200 gold price assumption. And if prices go higher, so does its value. Column spans over 1,000 square kilometers of greenstone deposits and could be Canada's next big gold camp. They also have Hollinger Tailings, a cleanup project that could deliver near-term cash flow. Across all projects, they've drilled over 16 million ounces of gold, which would cost over $2 billion to replicate today. With a seasoned team, Stellar Gold is one company to watch. Scan the QR code here on screen or visit stellargold.com/David Lin to learn more. How long do you think that these sectors can maintain their winning position? In other words, how transitory do you think these disruptions are, really?
First of all, it comes down to we got to do some damages. Well, there's two things. The first is the oil has to flow. And the reason the oil has to flow is that the longer the oil doesn't flow, then the higher risk of mass shutdowns along the supply chain. Because in other words, for example, a refiner, you can't keep a refiner online if there's nothing to refine. So at some point, if there's no crude coming in, at some point, the refiner has to say, I got to shut down. I got to furlough people. I got to, turn off the lights. Right. So that problem kind of just grows and it just kind of metastasizes down the supply chain. So it really comes down to how long can we go without having to have further downstream interruptions. So I kind of pinned that around June. By June, if this is not resolved, you're going to start seeing, I mean, the shutdowns will be starting soon anyway, but they're going to get worse past June, where the recovery time to come back is magnified. Now you're looking at, you know, 3 to 4, 6 months for operations to come back online after they've shut down. You can't just go, turn on a refiner like a switch. It's not a light switch. There's things got to be calibrated. Pressure has to be optimized. Blah 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 blah. So that's one thing. And then the second thing is how much damage assessment. We got to do a damage assessment, right? This is kinetic war action. Targets have been hit. There's been degradation of manpower, institutional know-how, facilities destroyed, facilities interrupted, and that's across the Gulf states, right? It's not just Iran; it's also UAE and Saudi Arabia. They've been hit, so we got to find out, how long does it take to get these places back online? Do we have spare parts? Do we not? What's it going to take? So you have to, once you've determined that kind of a timeline, then that sets the stage for, okay, I can be long these choke points for 18 months or a year or whatever it is. So it's kind of a chicken and egg problem in that regard.
Well, what do you not like right now? Which assets do you think are overbought or you think overhyped because of this conflict and what has happened with the oil and energy sectors?
So I think the asset that's most at risk is actually fixed income, and the reason is as long as the labor market holds up, which it's looking like it will. I mean, as of now, it's we're at 4.3% U3. As long as the labor market's fine, I think late in the year there will be kind of. I'm not calling for a hike. I'm actually calling for nothing to be done. But the Fed will start communicating and start leaning hawkish towards the end of the year, provided the labor market doesn't fall apart. And look, there's a tailwind to the economy. That's the AI spend, right? The AI spend is around 2% GDP. That is a huge buffer to and it provides resiliency to the business cycle. So as long as you've got the AI trade going on, I find it really hard to make an argument that the labor market's going to fall apart and therefore that the Fed will be incentivized or motivated to cut this year. I just don't see it happening. Going into the war, inflation was already picking up. I actually called for no cut back in February because of this, inflation that was percolating down the pipeline. So I think there are things outside of oil that the Fed is going to have to consider in their mandate, right? They can look past the oil shock. What they can't look past is, goods. Goods are increasing. Travel's going to increase. That's related to the oil shock, but that also takes on a life of its own. So if things outside of the energy complex that feed into core keep increasing, they're going to have to get on board with a hawkish bias. So I would say bonds would are more likely to suffer than any other asset class out there.
Bonds meaning, I guess, in the long end of the curve or the short end? What's your
Uh,
duration here?
uh, well, 10-year tenor, so it's about a 7% duration, but a 10-year tenor. So the 10-year is the answer.
Okay. Well, do you think precious metals have signaled? People have talked about how gold has signaled this conflict and has signaled higher inflation. And it's interesting how gold didn't really move up beyond what it did prior to the invasion or the attack on Iran, meaning gold actually fell alongside stocks. So, how do you think the metals complex is behaving right now? Is it normal for the metals, especially gold, to be going down during geopolitical stress?
I mean, this is entirely normal, right? So gold is seen as a hedge on, geopolitics or central banking competency, right? So it's your hedge, it's your insurance policy. So during a crisis, what do you do with your insurance policy? You cash it in. So in March, we had a huge deleveraging, and you sold what you could. You sold what you made money on. You sold what you wanted to protect profits. So the sell off in gold um, was entirely rational given the deleveraging unwind, and it bottomed right near the 200 moving. I'm talking about the metal, not the future contract or the ETFs, but the actual metal. So the XAU is the ticker on Bloomberg. The actual metal bottomed in late March as this unwind kind of took its toll. And once we got some signaling that an agreement could be in the works or a ceasefire, gold started front running that and started moving up. So people started accumulating again. The deleveraging cycle was for the most part at least paused, but gold behaved entirely rational. People cashed in their chips, and now that the crisis looks like it may abate on the geopolitical front, then it's getting a bid again. So. And I think the miners are very well positioned to profit off that move, right? So the miners are very heavily levered to the spot price, and yeah, I think the miners are looking good right here.
And the fact that the Federal Reserve has become more cautious in regards to inflation, how has that changed your assessment on bonds overall, or has your evaluation on bonds been independent of monetary policy?
No, I mean my views are informed, 100% or not 100%, but very much by monetary policy. And we did have a shift in the outlook in January as there were some members that were previously dovish or neutral start going to the hawkish camp, Neil Kashkari in particular. So I think the Fed is slowly um, you know will be moving over to the hawkish side. Now there is a slight problem right now, and that is the handover in leadership from Jerome Powell to Kevin Warsh. Right now, there's some political stuff going on, and looks like the can is kicked for a while on Warsh, but that may be resolved at some point, and at that we'll have a little more clarity once the leadership changes. But look, Kevin Warsh doesn't set policy; neither does Jerome Powell. It's a committee, and his job is to corral the committee into some unanimity or some consensus to make a decision. And we're just a little far off from that right now. He's not even in office.
Do you actually think there's a possibility of rate hikes this year, David?
No, my view is the Fed's not going to do anything. It's too early. Cut or hike, it's too early. Just for the reasons I mentioned. The labor market's holding up, and right now they're looking through the inflation implications of the energy shock. It's too early.
What will move the needle either way? Either hikes or nothing, or rate cuts, which is what was originally anticipated before the Iran war broke out.
Well, let's look at the Fed reaction function, right? Policy reaction function. They have a dual mandate, right? For the most part, they've been guided by the idea of we'll keep an eye on inflation. We'll attack inflation provided the labor market's not falling apart. They since the Fed pivot in November of 2023, the Fed has prioritized the labor market over the inflation mandate, simply because we were on the soft landing glide path, right? Inflation, what prior to President Trump launching the tariff war, and then again launching the this kinetic war in Iran. Prior to that, we were on a soft landing track. So, why bother with inflation? Let's support the labor market. And, they initiated a cutting cycle in that. And that's kind of the proof, right? If the Fed was still very focused on inflation last year, or, why would they have started a cutting cycle? So for now, they're still prioritizing the labor market. Um,
Yeah.
but if inflation rears its head as a result of things outside of the inflation energy complex, then that's a different conversation.
Right. So this morning, the BLS reported the latest CPI numbers. Headline inflation soared to 3.3%, its highest level since May 2024. Less food and energy core CPI remains at 2.6%, slight uptick as well, but not to the same extent as headline. To what extent do you think oil is still isolated? In other words, how concerned are you that higher oil prices will feed into core CPI and core PCE items that are not related to oil and energy?
Yeah, so there's things like core strips out energy, but there are still not knock-on effects, right? In other words, for example, dining services, dining out, right? Food's got to get trucked in. That's going to be impacted by um, the energy prices. So even the energy kind of finds its way into most things. So whether it's eating, dining out, whether it's travel, whether it's goods and services, energy always finds its way through the system. The question is, how impactful is it, at what rate, over what time frame? So my concern really though is on not so much on gas. It's really on food. I think we're going to see, just due to the issues with fertilizers. Fertilizers, they depend on sulfuric acid, which is a derivative of the uh, refining process. So there's going to be shortages of sulfuric acid, which are going to affect fertilizer prices, and that's going to get passed on to consumers in the form of food. And that's kind of one thing I'm watching. So food is a big one. Obviously, food's not a part of core, but food services is, right? Restaurants, people eat out, DoorDash, what all that stuff. So, again, many ways to find its way through the system. And I think food is um, going to be a kind of a node, a transfer point, if you will, into other sectors that feed into PCE. So yeah.
I want to ask you about this piece here. You have here a Substack called Economic Growth Update, U.S. Economic Growth Update. And in particular, you wrote about how growth in the U.S. could look more European if the supply shock lasts 4 to 8 quarters. First of all, 4 to 8 quarters is a long time, so that's one assumption in itself. But what do you mean if the U.S. were to turn more European? What does that look like?
So what it comes down to is, right, currently, pretty much before the tariffs, our economy was geared towards optimization, right? So, we wanted to optimize things to be more efficient and have wider profit margins, be more productive. And that ultimately is in the long term raises productivity I'm sorry, raises living standards. It's productivity. So, you become more productive by being more efficient. You do things like just-in-time inventories. You hold minimal. You warehouse things less. And in a situation where supply chains become permanently disrupted or disrupted for a long time, you as a business have to shift your business model from optimization to resiliency. Now you have to have redundancy in your suppliers. You have to have warehouse stocks. You have to prepare for bad outcomes, and that shifts resources from optimization to now resiliency. Now you're spending money on insurance. Now you're, again, it's just it's kind of a snowball effect. Ultimately, that impacts your profit margins, that impacts your productivity. Lower productivity, you become more European-like, more static, if you will, less dynamic. And that's what I meant about the productivity transmission channel. So what we want to avoid is kind of becoming, a more closed economy. Onshore. I get the strategic concern behind onshoring, but if you want to onshore everything and make everything, you're making goofy things like toys. What are you even doing? Then you're kind of just you're going against all basic economic models regarding trade and efficiency. So we don't want to end up in a situation in 12, 18 months, 2 years where we are now less focused on optimization and more focused on resiliency, survival. So we don't want that. We don't want to become the functional equivalent of preppers. These people that they got their basement full of food and whatever, preparing for the world to end. We don't want to be in that mode. We don't want to be economic preppers. We want to be dynamic. We want to explore. We want to take risks, and a resiliency type framework moves us away from that. And that's
You're right
exactly what
about
Europe
the
is.
Well, you're right about the abundance regime. Tell us more about that and why that's at risk of coming to an end.
Well, it's not so much the abundance regime. That's an input. The broader theme is, we've had counter cyclical productivity boom, the first one since the late '90s, right? In the late '90s, we had awesome growth. Stock markets are booming. Everyone's employed. And what was different about that is typically productivity is countercyclical. So productivity typically jumps when there's an employment extinction event going into a recession. People, firms fire people. They're doing more with less. So you kind of just have this mechanical productivity boom, and that's kind of been the basic thing since World War II until the '90s happened. In the '90s, we have this crazy boom, but people aren't getting fired. And then, .com happens and all that just gets shot in the head. Now, we, after COVID, we kind of start seeing the same kind of thing where, in the 2010s, productivity was around 1.7, 1.6, maybe lower. And now we're running like 2.5% productivity per year. And that's manifested in real time in S&P profit margins, which continue to be at all-time highs. So we have this situation where productivity is booming, employment's low, we're at 4.3%. How do we have this magic? So there's three stools to that. One of them is abundance. Abundance is one of the three legs in the bar stool that gives us this framework for boom, for productivity boom. Abundance means we can be optimal and not resilient. All right. The other one is full employment, which we currently have. And the third bar stool is actually falling off the top of my head right now, but it's in my writing.
Sure.
And so that's kind of here it is. It's the capex boom. So in the late '90s, we had the .com capex boom, and now we've got the AI capex boom. It's providing a tailwind of 2% of GDP spending, right? Almost $750 billion in AI spend. So those three things, the AI spend, full employment, and the abundance regime, are what support this whole framework of a productivity boom. And that's being jeopardized the more kind of self-inflicted, foot shooting that we engage in, that becomes jeopardized.
For the last section, David, I'd like to do a quick lightning round. So I think you
All
know the
right.
rules. You've seen this on the on game shows. I'll ask you for just your outlook or long or short something. Answer in 2 sentences or less, starting with GDP. First quarter is already almost done. Second quarter, are we looking at positive or negative?
Zero to negative is my bias, is the answer.
S&P 500 up or down by the end of the year?
Up.
Favorite sectors within the S&P?
Actually, like transportation and logistics. Obviously, that trade got murdered in March, but I do think we are seeing some kind of industrial renaissance. But so I think that's gonna come back. In fact, some of those stocks that I sold in March that were linked to that are actually back at all-time highs. So we're seeing it in the price action already.
Oil up or down by the end of the year from current levels, which is about $100 WTI.
I'm inclined to up, and the reason is these physical shortages, they're not going to be resolved. First we need a political settlement, so who knows how long that can take, and then the process of actually restarting refineries takes a while. So there's going to be physical shortages that will persist. So the answer is up,
So headline CPI, we're currently at the highest level since May 2024, up or down by the end of the year?
down.
Down. What about core CPI, excluding food and energy?
My focus is PCE, but they're generally, they're close enough as
Hmm.
proxies. The answer is by the end of the year, down. I think CPI or PCE, whichever one you want to measure, they will peak around August.
Okay. And so ultimately, the Fed then, will they be hiking rates or lowering rates this year?
They're doing nothing.
Okay. No change. Gold futures, are you long or short?
I'm currently long gold futures, and I want to be getting long the miners as well.
Okay. And silver?
I shorted that thing pretty successfully early in the year. It's too small of a market. It's not.
Hmm.
It's not a jungle I have to play in.
How do you play the AI stocks?
Honestly, I keep it simple and just buy the ETF,
Hmm.
XLK, I believe it is. I keep it simple. I'm not a stock picker,
Okay.
more of a sectoral generalist. So I just keep it simple.
Okay. What do we do with industrials like sulfur producers, fertilizers, nitrogen fertilizers, potash, so on?
Yeah, those are along. Industrials like Deere, those that have to pay more for higher inputs, those types are short.
Hmm. Okay. And bonds, we talked about bonds extensively. So at this particular point, long or short bonds?
Short.
Okay. Excellent. Thank you, David. Where can we find you? Where can we find your work and read your work?
Pinebrookcap.com on Substack, or you can just go on the internet, type in pinebrookcap.com. I'm also on pretty active on Twitter, econstratpb, and you can find me hanging around there.
All right. We'll put the links down below. David, it was nice to meet you. Welcome to the show, and I look forward to speaking with you again. Take care for now.
Thanks for having me. Take care. Bye.
Thank you for watching. Don't forget to like and subscribe.